Good evening everyone and welcome to Granules India's earnings call for fourth quarter financial year 18. To discuss business performance and outlook, we have with us Mr. Qtr4 Chigurupati, Chairman and Managing Director, Dr. Prasad Raju, Executive Director, Mr. Ganesh K, our CFO, and Ms. Priyanka Chigurupati, Executive Director of Granules Pharmaceuticals Inc. We will begin this call with opening remarks from company's management, followed by Q&A session. Before we proceed with the call, please note some of the statements made in today's discussion may be forward-looking and this must be viewed in conjunction with risks and uncertainties involved in our business. The safe harbor language contained in press release also pertains to this conference call. The transcript of this call will be made available in our website in due course of time. In case any additional clarification is required, please feel free to get in touch with me. With this, please let me turn the call over to Mr. Qtr4 Chigurupati for his remarks. Over to you, sir.
Thank you, Sumanta. Good evening, ladies and gentlemen. Thank you very much for attending our fourth quarter earnings call for the fiscal year 2018. I would like to share that we have reported an 18% growth in top line year on year. We have achieved these results on account of our expanded capacities at Bonthapally for APIs, Gagillapur for PFIs. This growth is across all product verticals, with API registering an 18% increase, PFI 22% increase, and FD 24% increase. Let me take a minute to present the significant drivers for this growth in sales. Our core product basket of 5 molecules has been the key enabler for growth in the last fiscal. Of these, ibuprofen has contributed majorly, followed by guaifenesin, paracetamol, and metformin in this order. If we look at contribution by geography, AMEA region was the top performer, registering the highest year-on-year growth by region, clocking more than 100%. Amongst other regulated markets, we have seen a revival in the Canadian market, with the growth rates coming back to historical levels after a dip in the last reported financial year. During the year, we commercialized the expanded capacities of metformin and paracetamol API in Bonthapally and the expanded capacity of PFI at Gagillapur. While increased capacities led to enhanced revenue realizations, geographic distribution of our markets in the last fiscal impacted profitability. We maintained the momentum of regulatory filings of drug master files submitted in the US, Europe, and other key regulated markets. We filed 4 US DMFs in the last fiscal, bringing our total US DMF filings with the US FDA to 21 as of March 31st, 2018. We now have a total of 11 CEPs with EDQM, of which 1 was filed in the fiscal year 18. There are a total of 6 EDMFs filed as of 31st March 2018, of which 2 were filed in the financial year 18, along with other regulatory filings in key regulated markets to support potential ANDA and dossier registration filings. We intend to operationalize some of our US DMFs by filing ANDAs to forward integrate into FDs. We have built a strong foundation and bandwidth in product development as well as filing ANDAs. As of March 31st, 2018, we had made 20 ANDA filings with the US FDA, of which 7 have been approved. Of the total ANDAs, we filed 10 in the last financial year, and we expect to file similar number of ANDAs in the financial year 18-19 between India and US operations. Fiscal year 2018 was a year of regulatory inspections at Granules. We continue to remain strong on our efforts towards achieving and maintaining highest levels of regulatory compliance. I am happy to inform you that during the course of the year, we have completed 4 US FDA inspections in 4 of our facilities. In addition, we have also had Canadian and Australian inspections at our Gagillapur facility. The emerging business division, which we have acquired through Qtr4, plays a key role for business expansion for both core business and US generics. Apart from supplying niche, high-value, low-volume APIs to third-party customers, it also provides support by supplying selected APIs for forward integration to FD in our core business. In addition, this facility helps the core business serve as a prominent CMO to other pharmaceutical companies by giving them access to in-house APIs, therefore strengthening the core with capacity and new products. Some of the regulatory filings in Europe is translating into increase in regulated market sales with partner companies. Construction of oncology block is going as per our expectation and is estimated to reach completion in the second quarter of the current fiscal year, 2019. We expect to start validations subsequently. I will be in a better position to give more details during the subsequent quarters. Moving to our joint ventures, I will first look at Granules Omnichem, as there have been concerns on how we will progress with the JV given its performance in the last fiscal. I would like to mention that we are on track with a 5-year, in the next 5 years with a 25% CAGR target we set ourselves at the onset of this fiscal. Fiscal year 2018 was a challenging year for the business as we had some off-take issues with a key customer delaying the date of shipment. This issue is now behind us and the shipment had been dispatched in the first week of April 2018. The focus going forward will be on de-risking concentration risk of the business by adding new customers and products to the portfolio. The impact of our efforts will be visible going forward. Granules Biocause, which supplies ibuprofen API, has continued delivering performance in the fiscal year 2018 as well. As ibuprofen API prices have shown an upward trend in recent times, we continue to benefit from the JV in terms of better realization and mitigation of supply risk of ibuprofen, PFI and FD, which is part of our core business. It is unfortunate that these efforts are not reflecting at an EBITDA and profitability level as we have been impacted by multiple factors, some of which were beyond our control. We have witnessed a decline in our gross profit margin owing to price increase in all our raw materials, including para-aminophenol and acetic anhydride. These raw materials are primarily derived from crude oil, and with oil prices witnessing an upward trend during recent times, our costs have increased significantly over the year. Average oil prices in the fiscal year 17 stood at $50 per barrel, and the price at the close of the fiscal at nearly $65 per barrel. Additionally, the increased local environment and regulatory requirements for API units in China have significantly reduced available capacities for some of our key raw materials, which had an impact on our cost structure for paracetamol. The impact of a fire incident at the facility of a major supplier in the US for acetic anhydride continues to impact us indirectly on margins for core products in our portfolio on account of disruption in global supply. In financial year 2017, unregulated markets contributed 33% of the total revenue, which has gone up to 38% in the financial year 18. We started supplying to these markets from our enhanced capacities as we await approvals to come in from regulated markets affecting overall profitability. The product mix was another factor which impacted margins. This year had been a mixed bag for our company, wherein on one hand we have access to enhanced production capacity, received multiple regulatory approvals for our filings and facilities in India and the United States. On the other hand, we continue to be affected by increase in prices of raw materials, thus impacting our profitability. We expect a turnaround going forward as regulatory approvals for the added capacities come in and we are able to supply increased quantities to geographies with better realizations. Also in the last 2 years, our company had invested heavily with the objective to further solidify our existing business and create auxiliary engines to drive sustained growth. As is the nature of such investments and the industry that we are in, there is always a time lag between the expenditure and realizations expected from these investments. We are creating the right framework for a higher growth trajectory. However, there is dependency on exigencies which are macro and industry driven and may have to take a cautious approach to sail through this gestation period. We continue to closely monitor our product development work and while continuously improving existing core product basket. It has been a difficult financial year at Granules in terms of pressure on margins. We look forward to consolidating our key investments going forward and focus on execution of strategies. Before I hand over the call to Ganesh, our CFO, let me introduce to all of you Priyanka, who manages Granules Pharmaceuticals, our US Generics division. She has been associated with Granules India for 5 years, during which she worked within the core business, emerging business, and consumer health divisions. I now hand over the call to Ganesh, who will share detailed insights on the financial performance for the quarter and the year. Thank you very much.
Good evening, ladies and gentlemen. Thanks for joining the call. Let me start off with the consolidated financials on the PAT number. Compared to last year number of 164 crores, our PAT dropped to 133 crores. I just wanted to highlight the key reasons for this drop of almost a 31 crore at a PAT level, despite of an increase of close to 18% at a consolidated sales. We relooked at the R&D policy. As you are aware, we were actually capitalizing the spend in GPI. Just to give a backdrop of GPI, we acquired a facility way back in 15 and we refurbished the facility for commercial use. As of now, no commercial production has happened and it is, we expect commercial production to happen in Q1 of FY19. What we have done is we have taken the entire expenditure spent in GPI. We have classified the expenditures under renovation, pre-operative and product development costs, which are sitting at, which are actually currently capitalized. We have actually picked up all the site expenses amounting to $16.74 million, which is 109 crore, which were attributable to the facility to bring up to shape for commercial production, and this amount was capitalized. Most likely by Q1, we should be actually likely to go for a commercial production, and thereafter, all the expenditures relating to site operations would be charged off to the P&L, and whatever has been capitalized, which would be roughly $36 million, would actually be depreciated. We identified all the product development cost by product, and we evaluated the progress of these projects based on technical and commercial viability. Based on the progress of these projects achieving certain milestones, we have capitalized $16.4 million, which is 107 crores, and we have written off $2.5 million, which amounts to 16.73 crores as development cost. We adopted the similar policy for GIL in India. Certain R&D costs incurred during the year on biostudies amounting to 7.16 crore also has been written off. A total of 24 crore pertaining to R&D has been charged off to this financial, which has actually led to this drop in PAT at a consolidated level. While we actually discuss more about a consolidated result, I just wanted to highlight the GIL standalone numbers with a very specific focus on capacity addition, what we did during this financial year, and the impact that it has actually had on the GIL standalone financials. While the turnover has gone up, our material cost increased from 49% to 55%. There are two reasons for this. We actually took a write-off of certain obsolete inventory to the tune of 12 crore based on aging and as well as on the obsolescence. We charged off 12 crores to the P&L. If you adjust for this, the total material cost would come down to 54. Nevertheless, there is a 5% increase. This our CMD has already explained in terms of the raw material price, which has actually across board impacted all our products. In addition to this, the capacity addition, what we did during the year, since we didn't have approval to launch metformin in regulated market, we were actually selling these products in the domestic market. The local market conditions, the price realization did not actually yield to too much of margin due to competitions and the local price conditions. So these two factors, one is dependence on domestic market as well as the intermediate price increase impacted around 6%, including the write-off of obsolete inventory. During the year, the employee cost went up by 18%, predominantly on account of annual increment as well as additional headcount augmented for the new capacities which we added in India during this financial year. The total other expenditures increased by 33 crores. This is on account of three major heads. One is on R&D, power and fuel, repairs and maintenance. The total R&D expenditure in India actually went up by 11 crore. This includes the 7.16 crore write-off we have taken, apart from the other normal R&D expenditure. Including this 11 crore increase, the total R&D expenditure stands at 35 crores. The power and fuel increased by roughly 10 crores. This is on account of the capacity additions we did in India. Predominantly, we added a PFI facility, metformin and paracetamol additional capacities in Hyderabad. Repairs and maintenance went up by another 4 crores. Based on the age of the facility, we need to actually keep up these facilities. And in terms of depreciation, it has again gone up by 4 crores. This is on account of capitalization of 289 crores, of which the oncology block accounts for 125 crore, which is still on CWIP, and we have actually capitalized the metformin, paracetamol block and module F, the PFI block. Our total long-term loans went up from 182 crores to 453 crore during the year. This is the ECB loan we are availing from IFC and DEG, predominantly for the capital expenditure in Hyderabad and Vizag. Now, coming back to our share of profit from joint venture, the Granules Omnicom profits came down from 12 crores to 2 crores during the current financial year. This is predominantly because of a customer requirement who wanted a particular consignment to be shipped in the current financial year while the product was already ready in the last financial year. This had a significant impact on our the profit share which came from Granules Omnicom. The shares from Biocause increased from 12 crores to 14 crores, and the marginal increase of 2 crores during this financial year. Now, with this, to summarize, our challenges were more on R&D expenditure, the capacity additions, which we are yet to fully utilize, and the local market conditions for some of the APIs added with raw material price increase across board. I think with this, I hand over to Sumanta.
Thank you, sir. Aman, we can assemble the queue for question and answer and take it up after.
Yes, please. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. first question is from the line of Parag Sari from Equirus Securities. Please go ahead.
Yeah, so hi. So just have few questions regarding the operational business. So just wanted to understand, you mentioned that the P&L will be now going through P&L, R&D will be going through P&L. So just wanted to understand how, to what extent it will be, and where all you are going to spend this money.
Today, you have to actually split the total expenditure of GPI under two buckets.
Sir, on a consolidated basis, if you could talk.
Okay. Now, the total R&D expenditure would be in the range of 120 to 130 crores.
Right.
It also depends on the progress of certain molecules. Based on if it passes certain stage gates, we would actually capitalize the expenditure. If the feasibility and the technical viability is established, we can actually capitalize. If not, we will be actually charging it to the P&L.
Okay, and currently how much we were charging? In FY18, how much we charged?
This year we charged 24 crores.
That is on consolidated basis.
So this is on GPI. On the consolidated basis, 52 crores.
52 crore, and rest was capitalized, right?
Yeah.
So, to just clarify, so 70 crore was capitalized, right? 70 to 80 crores.
No. During the year, we capitalized 102 crores.
So you said that overall R&D spend was around 120 to 130 crore. So, and 52 crore was through P&L. So remaining will be 70 to 80 crore, right?
No. The number what I'm referring is for the current financial year. What we propose to spend next year, today I will not be in a position how much would actually go through P&L, how much will go through balance sheet, because it depends on the progress of the project, and if it meets certain criteria in terms of project success, certain expenditures would be capitalized. Today I will not be in a position to state that because it depends on the progress.
Understood. So on CapEx plan, is there any further CapEx you have scheduled for FY19, or we are almost done with our CapEx?
There is still some ongoing CapEx for which the funds are available with us, and there is no new further CapEx.
Okay, and what will be the amount of that?
Sorry?
How much we are going to spend on our CapEx for FY19?
We need to complete the oncology facility. The total budget for that is around 266 crores. And what is actually in GWIP is 125. This project has already started, and we should be completing this project by Q3. The addition to the gross block would be in the range of maybe approximately another 100 crores on the oncology.
Okay, and last year how much we spent, to have a specific number?
The total capex we spent in GIL is 289 crores, total, of which 125 is for oncology, a greenfield project, and core is 164.
So, on consol basis, if you could provide?
On consolidated, it will be around 500 crores. We have spent in addition to the 289, we have spent 184 in GPI, and we have spent another 32 crore as an equity investment in an associate company called US Pharma. So total is 500 crores, 505 crores.
Sir, hello sir, this is Viraj here, I'm Bharat's colleague. Sir, the math still doesn't add up to some extent, because we raised around 300 crores from equity. Our long-term debt has gone up by 400 crores this year. So that's close to 700 crore addition to our liabilities, which is just long-term. So 500 crore gross block addition doesn't add up, because the amount of money, and I'm not even considering 130-40 crore PAT we have done this year. So what am I missing?
The increase in working capital.
Okay. And sir, due to the performance of the company, the stock price has fallen to 81 bucks. I understand that's not in your hand, but what will it affect is the pledging that the promoter has done with the lenders. Can you tell us how does that affect, let's say at 70 bucks, 65 bucks? Because that's very important for a minority shareholder to know.
Okay, the pledging I may have to increase a little bit more, but most of the security is going through certain lands and other properties. But it doesn't mean that we won't increase the pledge. A little pledge will be increased. But the primary security will come from other means.
Sure. And sir, just last thing I wanted to know from your side is, we have almost bet the house on the last capex that we have done in the company for last 1.5 years, if I include the completion of the oncology, because the total capex we'll be doing is almost close to 1,100 crores, which is more than the profits the company has made in its history, right? So that does make an investor slightly nervous. What I just want to understand is, till we completely utilize all of this to at least 80-85% utilization, does the management have any other scope of doing any more capex? If new projects come, will we keep doing more capex, or now it is the time to generate free cash flow and reduce debt?
I think you got it absolutely right. There is no plan for capex. We have to extract returns on whatever we invested. We did invest quite a bit, like you said, more than the profits generated. But then we are pretty sure these are going to yield returns, some in the short term, some in the medium term, some in the long term. And again, to reiterate, there's no plan for additional capex.
So, once we complete oncology, we are done?
We are done.
Okay, thanks a lot, sir, and best of luck.
Thank you.
Thank you. The next question is from the line of Sangam Iyer from Shipcom Ventures. Please go ahead.
Yeah, sir, just wanted to understand, could you just run us through in terms of the gross margin that dipped during this quarter of almost 10%? What exactly were the contributors to this dip in the 10% gross margin reduction?
I had actually talked about 3 reasons. One was key intermediate price increase. It actually affected almost all our products. Key ones like PAPs and acetic anhydride, DCDA, all these things actually impacted our price. Second, we also took a charge on obsolete, non-moving inventory to the tune of 12 crores. And also certain capacities, actually we were able to sell the product in domestic market where the price realization was not that attractive. So all these 3 contributed to the dip in the margin for Q4.
Because if I look at your Q4 breakup, the metformin sales that you're alluding to is almost flattish sequentially. And what has actually increased is the ibuprofen sale, and that ibuprofen sale actually has a very good tailwind in terms of the prices shooting up significantly. So I'm just not actually able to add up, because when I look at your Q3 and Q4 numbers correspondingly, the component that has gone up significantly is the IBU sales, right? And that has been the predominant contributor in terms of the 90 odd crores of increase. There is a 70 crores increase from the IBU sale itself. So if are we saying that here IBU sales actually happened at a really abysmal kind of a margins, which led to the gross margin dip of almost the 1,000 basis points? I mean, what exactly led to this? Because when you say metformin is flat sequentially, so that should not have had a dent on your overall profitability.
When you look at metformin, you have to actually understand which vertical the increase has happened. We sell metformin all the 3 verticals of API, PFI, and finished dosage. Finished dosage of metformin is really profitable. Actually, the jump in sale, in terms of quantity, it has actually happened. We were able to sell more APIs in the domestic market with not so attractive prices.
Okay. So, sir, then going forward, if I were to adjust the 12 crore of chargeback, given the the shortfalls in terms of the raw material availability and the price hikes that we have seen in the IBU intermediaries, etc., how should one now look at the margin profile? Because current gross margins are something which, it's very difficult to understand how to go about, how to look at the Granules in terms of where the margin profile would settle down, given the uncertainty in the way crude has shot up and also the fact that your other key raw materials, because of shortages across, are also moving up sharply. So could you give us some roadmap in terms of where to look at the, where the gross margins would settle down in the next couple of quarters and then for the year going forward? That would be really very helpful to understand how Granules will fare.
Let me explain. The gross margins on all the finished dosages will actually increase from what we did in the last quarter. The reason being, we were able to get price increases from customers due to increase in raw material costs, but by the time we got price increases in raw material and selling price increases, the raw material prices again shot up. So there's always a lag between getting the price increase and actually having to spend more on raw material. So once the prices stabilize at certain level, which we feel definitely it has to happen shortly, then we will reap the benefit of better margins. Same thing with our products like paracetamol, API and PFIs, where we have multi-year contracts with the big pharma companies. These places also we have an arrangement where we have a formula-based pricing, where the pricing of this quarter we take into account and adjust the sale price for the next quarter. So there's always a 3 month, a quarter lag there. So the minute these things settle down, we would be going back to our original margins. And 22%, 21% EBITDA was what we were making in the past. We are pretty confident we should do at least 19% going forward.
So
the main drivers will still be the formulations, metformin and ibuprofen. And of course, we are also launching other products in this year. We are launching metformin ER. We are launching methocarbamol finished dosages. We got approvals recently. Yeah. And these two products we are launching by ourselves. So they will not be partners. So going forward, when we add more products, our profit margins we don't have to share with other partners. There will be a better increase there. And also, we have launched fexofenadine in this quarter. Sales are looking attractive. We are going to launch cetirizine in this quarter. So this is the first year. Within 4 months, we were able to launch 4 products. So this is very encouraging. We are very, very confident this is going to yield results too.
So, sir, would it be fair to then assume that, the 18% EBITDA of Q3 that we had, we can actually come back to that by the end of the first half itself?
Yes, definitely. Like I said, 19% is what we are looking at.
As an exit for the year or average?
No. For maybe the first 3 quarters. Fourth quarter, we expect it to be better.
Okay. And sir, one more question on the balance sheet side. If I look at the overall sales increase, which we did for the year was around 250 odd crores, and our receivables have also increased by almost 200 crores. Could you help us, the sharp increase in the receivables?
If you see our sales for the last quarter, there's been a very big increase in the last quarter.
Correct.
And most of these, or some of these finished dosages which we supply to the US market, and these go at 120 to 150 days credit. Since it happened in the last quarter, the receivables shot up.
Okay. So they should normalize.
If we maintain the same sales, they will not be shooting up again. But they will shoot up to some extent because we are anticipating higher sales going forward in this fiscal year.
Yeah, but when you say receivables, so these are already booked, right?
Sorry?
So this was the Q4 sales that happened
to
the US.
That's right.
So Methagin, we have already started the supply?
I think Priyanka is on the line. She's Executive Director in our US facility. Maybe it's a good idea that she responds to this. Priyanka?
Hi. Yes, we have launched Methagin.
Yeah. So we have launched Methagin. Okay.
Yes.
Great, ma'am, and all the best.
Thank you.
Thank you. The next question is from the line of Nisarg Vakharia from Lucky Investment Managers. Please go ahead.
Good evening, everyone. Sir, I had a question that assuming that the current challenges that we are facing in terms of raw materials, API, acetic acid, assuming that we do not know how long these structural upward price revisions last, do we have the capability and the power in our business to keep taking price increases?
We definitely were able to do it so far, and our contracts with the big pharma do enable us to get the price increases. So about 50% of our sale, it's an automatic price increase, and the rest we have to go negotiating with people. And if this is the price increase for everybody else, nobody will be able to supply at a lower price. I don't think anybody will take a loss. So I don't see a major issue. I don't say it's easy, but I don't see a major issue going forward.
So I'm not asking if somebody can take a loss, but structurally, let's say we have enjoyed 21-22% EBITDA margins in the past because of tailwinds in a lot of our raw material. So structurally, can we enjoy those margins at some point of time, considering that we can take price increase? So, sir, I understand that there was a extreme shock in acetic acid prices. But assuming there is no shock, then we can go back to our previous margins. That's what I want to understand.
So we are seeing a softening of acetic acid as we go forward. And even acetic anhydride prices, they went up from 60 rupees to 120 rupees.
Right.
It's almost 100% increase. But now they have slid down to, right now it's about 95. We expect it to go down further. And moreover, where we have entered into contracts with some of the suppliers, wherein it's all formula-based. It's linked to acetic acid price. Actually, they took advantage of the shortages some time ago. It's not just linked to acetic acid, but now it's linked to acetic acid, and we see going forward it's going to come down. And we also are looking for alternate sources.
Sir, I'm sorry to repeat my question, but again, I'm asking that assuming that prices don't go down, assuming the prices remain exactly where they are, does our business have the power to take the price increase and go back to 19-20% EBITDA margin?
If they don't go down, absolutely, I don't think 19% is possible. Maybe it will be lower, maybe 16%, 15%.
Okay.
I agree with that, yeah.
Okay, sir. Thank you so much for answering my question.
Thank you. The next question is from the line of Mangesh from HDFC. Please go ahead. Mangesh, your line is unmuted for questions. Please go ahead. It seems there's no response on the line. We'll move to the next question. That is from the line of Bharat Celly from Equirus Securities. Please go ahead.
Yeah, hello sir. This is Bharat's colleague Viraj here. Sir, for metformin, we had almost increased our capacity from 2,000 tons to 9,000 tons, and we are gaining incremental market share. But our competitor Aarti Drugs is also increasing its capacity from 7,000 something to 12,000 something tons. 15,000 tons, sorry. So how does this affect the market? Because if everybody keeps increasing capacity, what we understand is the market is only growing at around 5 to 6% volume growth.
Yep. Okay, let me answer that. Some people are increasing capacities, and there will be a bloodbath in the domestic market and maybe in the Latin American market. But what we have been concentrating on all these years is the regulated markets, US, Europe, and Canada, of course. So these are markets where we have a very good market share, and mostly in finished dosages and PFIs. And these are sold at a better margin than APIs even in those markets. So we have a captive market, and the only thing we are waiting for is approval from the US FDA and European authorities to use the material from our Vantapalli, the new facility, and wherein we could use it into our... We also today keep buying a lot of metformin from outside. We buy a lot from outside, and in addition, because of shortage of capacity, we have done a site transfer of metformin to a Vizag facility. Vizag facility has a lot of other products to produce, And the day we stop that, that facility also can utilize capacity in a better way. So the minute we have this approval, we will stop. In Vizag, we have been producing about 1,800, it's not 2,000 tons, it's altogether about 4,000 tons is our capacity today. So 2,000 tons in Vizag will stop, which can straightaway go here, and some of the metformin we buy from the market can go here. And with this sort of capacity, we can look at increasing our market share also in certain markets. Only in the profitable markets, we don't want to get into a bloodbath with other competitors in under-regulated or less regulated markets.
So, in short, if I understand correctly, you are saying that in metformin, there will be bloodbath, but we have no intention of participating there, and it should not affect us.
Yes, and also, that is the worst case, but there is a possibility while people are adding capacities, there's a possibility that some people may be shutting down their capacities too.
Is there any company you know of is shutting down the capacity?
Oh, no, I think you should do a little bit of research yourself. Let me not say anything today.
Sure. Thank you. I'll get back in the queue.
Thank you. The next question is from the line of Ritika Chalan from Narnolia Securities. Please go ahead.
Hello.
Yes, Ritika, good evening.
Yeah, good evening. Actually, I want to know that are we facing any kind of pricing pressure in the US market?
Like I always said, we have never faced pricing pressure. We had only facing margin pressure because of increase in raw material prices. And in fact, we were able to get price increases.
Okay. And the filing that you have made so far, what is the market size, if you can say that addressable market size?
Priyanka, for you.
Sorry, can you just repeat that question, Ritika?
Yeah, the filing that you have made so far, if you can explain what is the addressable market size of that product?
The estimated value of that product of Metrogene as of today is $70 million.
Okay. And one thing more on the gross debt side, where should we be around at the end of FY19 or starting FY20?
Ritika, can you come again? I think we lost you a bit.
Yeah, hello. On the gross debt side, where we will be around for FY19 at the end or starting FY20? Gross debt.
Okay. Ganesh?
Gross debt will come down by, no significant reduction will happen in FY19. It will come down by hardly a 20 crore. FY20, it will come down by almost 6 million euro.
6 million euro. And FY19?
19 should be around 20 crores.
19 should be 20 crore and FY20 6 million euro. Hello?
Yeah, you're right.
Yeah. Any guidance on the tax rate side?
Actually, we pay full tax, so there is, we don't have...
I mean, what is the percentage we can assume going ahead?
It would be same as the current level.
Same as the current level. If you can give the segment-wise revenue, what was the finished formulation percentage, PFI and the API for fourth quarter?
For fourth quarter, percentage of PFI, API.
Fourth quarter, our total PFI was at 24% of the total turnover. API was 40%. Finished dosage was 36%.
Okay. And geography-wise?
Geography?
Yeah, means what was the North America?
Yeah, North America was 34%. The total share of North America was 34. Europe is 20. India is 19. EMEA is 12. Right. LATAM is 11.
Yeah. Latin America is?
11%.
Okay. And other one, what was?
AMEA.
North America is 34? Okay.
AMEA. The third one was AMEA, Asia and India. And,
Okay. 19.
Yeah.
That's it from my side.
Thank you.
All the best for future.
Thank you.
Thank you.
Aman, can we go ahead?
The next question is from the line of Ranveer Singh from Systematics. Please go ahead.
Yeah, thanks a lot for taking my question. Just though, I heard certain write-offs which have been made in different line items, but can you give a consolidated basis what a total write-off we have done and present in other expenditure?
What I would actually call it as not the normal expenditure, like if I take it as one-off, not one-off, different from the previous year, it will be total 36 crores. 24 crores on R&D and
36 crores altogether.
Total 36 crores.
For quarter you're saying or for year?
For the full year now.
For year, no? Okay. And R&D front also you said that in GPI, because this number is on consolidated basis or for standalone you are talking about?
This is on consolidated basis.
Okay. So what was on GPI? What was the write-off?
GPI is around 17 crores.
And of 17 crore, what was it related to R&D?
Yeah, it's related to R&D.
Okay. And you wrote off on certain non-moving materials also. So what was the amount? How much has been written?
12 crores.
1 crore for this quarter?
12 crores.
12 crores.
12. Okay. For full year. Okay. Fine. And so what I see, though we have a good pipeline for US, and we see that capacity is also getting ramped up. Meanwhile, margin is getting squeezed. What I'm concerned with on balance sheet, going forward, in case margin doesn't move up, then how we are going to manage the cash flow, because balance sheet remains in a very tight position. And our ability to increase debt is also limited. So what may be the scenario which may happen if margin doesn't increase from here?
At this point of time, we don't have any plans to have any additional debt. We should actually either stay or reduce from the current level. We believe we could actually manage our requirement for the current financial year.
Okay. What is the gross debt as of day?
Gross is slightly, it's around 978 crores. And we also have a cash of 97 crores. So the net debt would be somewhere around 890 crores.
Okay, fine. That's it. I'm in queue in case I have more questions then.
Thank you.
The next question is from the line of Sri Hari Seth from PCS Securities. Please go ahead.
Yeah, thanks for the opportunity. My questions mainly pertain to GPI. Could you please tell what has been the total capex incurred to date? Of that, how much is the development cost? And if you could please touch up a bit on the pipeline encompassing even the addressable market size. Thank you.
I think Priyanka can take that.
Ganesh,
you answer that, Ganesh can take that. Priyanka?
Sure. So we filed 7 products over the past year, and we have about 16 products that we're working on right now, and are targeting to file about between 8 and 10 products this year. In terms of addressable market size, it runs to the couple billions because of the various number of products that we're looking at this point.
Okay, so in all that would be a current pipeline of around 23?
Correct.
Okay. Of these, how many would be, let's say, low competition products?
We would say low competition is a little bit subjective. So I would say that we're looking at least 60% of our portfolio to be low competition.
Okay. that leaves the cost.
And with respect to the other 40%, what we're doing is we're looking at products that are already in the market, and we're looking at making them more process efficient by using some technology that we have in-house. So that's the combination of products at GPI at this point.
Okay.
Yeah.
The CAPEX part of it?
In terms of investment, we have made roughly $65 million till date, of which roughly 36 million would be in the plant and machinery and the CWIP. We will have investment in GPI to the tune of 7 million, and the remaining would be more in the development cost.
So about $20 to $25 million is the development cost?
It will be around 17.
Okay. Okay, fine. And secondly, on the Octus front, the erstwhile Octus front, how many products from that basket are there in the market, and how many you plan to get on stream in the medium term?
Okay, I think Dr. Raju will answer this. So there are 7 filings that we have done it in 17-18 so far. And at least 50% of them should be getting to commercial phase within this financial year.
You're saying all of them pertain to Octus products?
That's right. New products developed in Octus, in that facility.
Okay, so as many as 7 are from, let's say, that basket?
Yeah.
Okay.
As you understand, the Octus, that particular multi-product manufacturing site, it makes products which are intended for the integrated play both at Gagillapur site and also at GPI. For example, what our chairman has mentioned, cetirizine and fexofenadine, these kind of products that we do, convert them into FD at our Gagillapur site. Right. There are few limited competition space products what Priyanka was talking. The limited competition is primarily stemmed out of API non-availability. That has been addressed, and we have filed few products, and we are also in the process of filing. Those products value realization happens at.
So, is it possible to mention a few limited competition products that you're talking about?
Few filings that we have done it in the public domain, and rest of the things we are not able to mention the names right now.
Okay. So, cetirizine, fexofenadine figure in the product portfolio when it was acquired?
They were not there, and cetirizine was there, but we have done the filing extension to US, and fexofenadine was not there. That's what we have developed and filed from that site.
Okay. So, basically, if you look at it historically, then cetirizine is the only vintage product.
Yeah, from that side. From that side.
Okay. Fine. Thank you.
Right.
Thank you. The next question is from the line of Deepan Shankar from Trustline PMS. Please go ahead.
Good evening, everyone. Thanks a lot for the opportunity. Just want to understand the opportunity size of Methergen and also to understand more, Lupin is the only other player available. So considering this, what kind of price erosion one can assume in a 2-player market, and what kind of market share we can allude to?
Priyanka, for you.
I'll take that question. As I mentioned earlier on this call, the equity value as of today is about $70 million. And as you know about the competitive scenario, there's one other company and us, which is the brand that you just mentioned. In terms of market share, we will capture our fair share of the market. And the goal here is to be a responsible player and to enable that price erosion does not happen. So while there will be a little bit of a decrease in price, which happens when there's a generic launch, we don't see too much of that happening.
Can we assume some 30-40% erosion?
I can't put a number to it, but I don't think it will be that drastic.
Okay. And we can reach some 30% kind of market share?
again, I don't want to commit to any numbers, but our goal is to reach more than that. It might come on immediately. It can come in a little bit later. But yes, our goal is to go higher than that.
Okay. And with regard to metformin, this facility approval from customers, so what could be the timeline when we can expect from the customers?
What we have actually done was we have extended our file from the existing site to here. And the amendment has already been filed, and the dossier submission is happening right now. In the next 6 to 8 months' time, we should be able to get the approvals from the customers as well. So we see the regulated market sale from Q4 18-19.
This recent depreciation in rupees, so how does this impact overall for us? So in terms of revenues, raw materials, and also in terms of interest and debt repayments?
It does definitely help us quite a bit. And if you see our imports against our total sales are around 40%. So there's a net forex gain here. It is going to help us. And also for repayment of our ECB loans also it's going to help us. Both are going to be offset, the increase there and here.
So how much of our loans are euro and USD denominated?
All our loans are in euro. We have a cash flow hedge designated for this euro loan, so this will not have any impact in the P&L.
Thank you.
Thank you. The next question is on the line of Tushar Bora from MK Ventures. Please go ahead.
Yeah, good evening. Thanks for the opportunity. First, very quickly, if you can help with the status on the in-licensed portfolio, US Pharma, where are we on those drugs?
Priyanka, again for you.
Sure. We in-licensed 4 products from US Pharma. The first product, we launched last year. And for that product, there is about 5 players currently in the market, which has increased from 3. And we have been able to maintain our market share. And with respect to the financial considerations, we don't want to get into the detail. But with respect to Lorazepam, which is another product, the ongoing litigation will take about 3 or more years. So we don't see a launch happening before that. With respect to the other product, there will be a launch next year when the pediatric exclusivity expires for one of the products. And we're expecting that to happen around the August time frame. And for the final product, that would take a while. We're expecting the launch to happen after 2025.
Great. Thanks. And how about the OTC portfolio? We were planning a OTC strategy. I think we reset the strategy in 2015, if I'm not mistaken. And we were trying to go out on our own for marketing these products. So what's the status? We haven't seen any material revenue booking from OTC in the last 2 years. Where are we in terms of the strategy?
See, I think one important thing to consider over here is that the molecules that we're playing with are built on high efficiencies, and we see a gradual increase in market share for those molecules. Just to give you a number, we have about 12 customers that we added on this year, and just for products that we currently have. But right now, what we're doing, we have filed a few products from our India site, and we have been receiving approvals. Like the chairman said earlier, we've launched 2 other products, Cetirizine and Fexofenadine, and we have managed to gain a certain number of accounts from those molecules. In addition to that, what we're doing is we are working on products that we are licensing from other players, including a few from our partner companies. And those are products from different dosages, and that should help us differentiate our pipeline. And as any B2C business goes, the growth in the initial years will be a little bit limited. And once you establish yourself in the market in terms of portfolio and your supply security, the customers will keep the momentum going with giving you more and more business.
Thanks, but just to be a bit more specific, when we exited from the previous strategy or sort of changed the strategy, we were, I think, doing about 100 to 120 crores on the OTC side. And where are we today, and when do we expect to at least cross that number?
I'll take that. Tushar, first of all, in the front-end OTC marketing, that's called the private label business, we are doing, it's growing, it's doing fairly well, and this is being booked in GUSA as sales, our subsidiary in the US. And what we have done, while we changed our strategy to go direct, again, very quickly, we realized we are foregoing sales to our other customers who are also supplying to the private label business. So we went back about 2 years ago. We started supplying to them again. And today, if you see, the business, the sales to these people is more than 100 crores already. And it's growing now with the products like Fexo, Cetirizine, and we see a big jump in both our front-end marketing and also to these other companies. It's actually much more than 100 crores today.
Right. So thanks for the clarification. One very quick question on the write-offs. We mentioned 36 crore, not write-off, but impact, additional expense impact in this year. How much of it has been taken in Q4? Because the numbers in Q4 look extremely bad vis-a-vis the other quarters. So we would assume that a large part is taken in Q4?
Yeah, the entire thing has come in Q4.
The entire 36 crores has come in Q4?
Yeah.
Or so if you were to just normalize and, sort of break it over 4 quarters, what would really the profit of Q4 be and vis-a-vis the previous quarters? If you can just help me with that.
It should be about almost 18 crores higher, possibly. Yeah, 18 crores higher. But we are not trying to look at a very optimistic scenario like that. So let's perform this quarter and then we can talk to Tushar.
Right, sir.
It will be much higher, you can guess that.
Right. Thank you. And one last question. Just if you can help us again on the near-term launches, the recently done launches in US, and what are the products that we can expect, say, over the next 2 quarters?
We could expect one more product, definitely in the next 2 quarters. But next year, going forward, we see about almost 7 to 8 products being launched.
And all of these would be on our own, or any of them, like Methargin, for example, is it partnered or is it on our own?
Methargin is partnered, but all other products will be on our own. Today, this quarter and early next quarter, we are launching these 2 products, Metformin ER and Methocarbamol. And all products going forward will be launched by ourselves. We just have to prove our reliability to the distributors that we supply on time. And once we set up these accounts, we have to go cautiously, not over-promise. So once we deliver, in the next few months, we could always add the other product that's coming in. And next year, they and we will be very confident of handling more products ourselves.
So Methargin also we will shift at some point to our own front end, or we continue to remain partnered on that?
Methargin, we will continue to remain in a partnership because we will be having some licensing fee and all that has been agreed upfront payments.
So if you could just explain what the structure is. I'm sure it would have to be discussed.
Confidentiality with our partner. I don't think we could share that at this point in time. But maybe once they make their announcement, we can think about it.
Okay. Sure. Thank you so much.
All I can say is that, sorry.
Yeah, please go on. Please go on.
All I'm saying is the terms of the deal were such that we will be giving them a fair share, but it's a very favorable structure to us.
Okay, sure. Thank you so much. That'll be all from my side.
Thank you.
Thank you. The next question is from the line of Amay Chalke from HDFC Securities. Please go ahead.
Hello.
Yes.
Yes, sir. Thanks for taking my question. Just if you can guide for the FY19 kind of a top-line growth, because most of the capacities are coming online. So you have guided for the margin. If you can guide for the top-line target we are looking at.
We could look at somewhere in the mid-teens to high teens.
And this would be largely driven by the APIs or it would be formulation?
It will be driven by all three segments because previously we couldn't do more tablets because we didn't have enough PFI capacity. So it will be a growth across all segments.
Okay. Thanks for taking it.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. On behalf of Granules India Limited, that concludes this conference.